Hello, I'm Cindy Williams, and we are very pleased that you could all join us today for a romp through the ABCs of fund finance. This is part of a continuing series of webinars that we at Deckard are doing for those involved in private capital and in permanent capital. First, some housekeeping. This webinar has been approved for CLE credit in California, Connecticut, Illinois, New Jersey, and New York. If you would like to receive CLE credit, please print the affirmation form sent to you so you can note the code when it is read later in the program. Forms should be returned to the email address at the bottom of the form. Now let me introduce our speakers. Chris Desmond will discuss subscription facilities. Chris does subscription facilities for both domestic and global fund structures, as well as loans to SPVs and CLOs. Matt Kerfoot will tell us about NAV financings. Matt does all types of fund financings, including financings structured as derivatives and synthetics. Jay Alacandri will explain asset-based lending at the fund level. These are financings secured principally by loans. Jay represents BDCs and funds as borrowers and banks as lenders on fund-level ABL facilities, as well as originating the leveraged loans that secure them. I will discuss asset-based loans at the subsidiary level. As co-head of our CLO team and active in credit fund formation, we frequently see these loan to SPV facilities used by funds and BDCs to finance their own portfolios and by CLO issuers for warehouses. Ian Hartman comes from a more corporate perspective and will discuss other types of debt that may be used by BDCs and other registered entities, including baby bonds, convertible bonds, and private placements. And with that, let me turn it over to Chris.
Thanks very much, Cindy. This is a brief outline, just listing kind of in order what we're going to talk about today. I'm not going to spend any time on this slide, but just wanted to make sure that you had it for your reference so that you could follow along. The first thing that we're going to be talking about today are subscription facilities, which I think makes sense to discuss these first, as chronologically they're very likely the first form of financing that will be utilized by a new private fund. They're often negotiated before the fund even closes in parallel with the fund documentation, and in fact, there are certain things in the fund documentation that the lenders may look for in order to have a subscription facility in place. Fundamentally, a subscription facility is a credit facility where the lender's primary collateral is the underlying capital commitment of the fund's investor base. That means that the primary credit underwriting by the lenders is done on the investors whose commitments are being lent against, rather than the investments that are being held by the fund. They're very popular in the private fund world, particularly in the early stages of a fund's life cycle, when there aren't sufficient assets to lend against and when GPs don't want to have to call capital from the investors every time that they buy an asset. This is what the security package would typically look like. A capital commitment is ultimately just a contract right like any other contract right, and so a pledge of the fund's right to call capital is as effective as a pledge of a loan or any other asset. Accounts and proceeds are pledged as well to ensure that the lender gets what is bargained for, so if the capital commitment comes in, cash comes into the fund, it gets put into an account, the lender will have a lien on that account that they can perfect and that they can take control of the account if they need to pay themselves back. I'm just mentioning it briefly here. There are some subscription facilities that are set up as what we call hybrid facilities, where the lender lends against both the capital commitments but also the fund's investments and would receive borrowing-based credit for the assets owned by the fund as well. So the ability to borrow in a subscription facility will decline as investors' capital commitments are called, while the fund's investments, one would hope, would increase as those investments are made. Often a subscription facility would get refinanced out with an asset-based line, but a hybrid facility builds elements of the asset-based line into the initial subscription facility itself, which can be a very efficient way of obtaining longer-term financing rather than negotiating a subscription facility at the closing of the fund and then a separate asset-based line 6 months later or so. So why do a subscription facility in the first place? Three main reasons. I think there are 4 bullets on this slide, but you can see the 3 main reasons there. 2 of them relate to liquidity and ease of execution, and then the third that's more economic. So first of all, it allows the fund to move quickly when making investments. If the manager becomes aware of an opportunistic investment that requires cash in a couple of days, the fund can draw on the subscription line in a day or two, rather than waiting 10 business days after a capital call for cash to come in from investors. Second, it avoids going to the fund's investors for each new investment and pestering them, essentially. So if the fund is making new investments every week or two, rather than calling investor capital over and over, it can draw on the subscription line to fund all investments for a period of time, and then make one true-up capital call every quarter or so for all of the investments, and use the proceeds of that capital call to repay the lender, again, rather than having to go to the investors for each investment up front. And then finally, because the subscription facility allows the fund to make investments without immediately calling investor capital, it can actually significantly boost returns on capital. So note that lenders view a subscription facility used for this purpose as fundamentally different from one that's used for liquidity, and will underwrite it differently as well. So many liquidity-based facilities include limits on how long any individual draw can be outstanding, maybe 90 or 120 days, to avoid the facility being used for leverage. And also note that last bullet. More sophisticated investors may ask for IRR to be calculated off of deployed capital to ensure that the GP doesn't use this to game returns by only calculating IRR off of called capital, even though it's been actually making investments for a while longer. What are some of the downsides? So a subscription facility pretty much by definition requires the lender to underwrite your investor base. That means providing investor financial information. It may require investors to sign side letters with the lender agreeing to fund capital calls made by the lender, which is obviously a lot of direct contact, ultimately more than you may want between your LPs and a third-party bank. For Cayman funds, for one thing, it will require at least providing notice to the investors as a matter of Cayman law in order to perfect the security interest. As I just mentioned, many facilities require any draw to be repaid in 90 or 120 days to ensure that the facility is only used for liquidity and not for leverage. And then finally, as the fund draws capital from its investors, undrawn capital commitments will obviously decrease, which means that the ability to borrow on the subscription line will decline over time. One reason that subscription facilities get refinanced out with asset-based financing is to allow for further borrowing once the capital commitments are exhausted, and therefore you have no more borrowing base to lend against. Here are some typical terms for subscription facilities. We've got a lot of slides to get through today, and I'm not going to go into detail on these terms. The market for these facilities is pretty well established, and the big picture economic terms don't move around all that much. In addition to the unused fee and margin, negotiations over these facilities typically center on which investors or types of investors the lenders will lend against and how much credit to give for them. So one of the things you want to do very early on in the process is show the lenders basically, hypothetically, these are the investors that we're talking about. What kind of borrowing base would I get for these investors, and what can you allow? You also will end up negotiating the amount of contact between the lenders and those investors when and to the extent that cash gets trapped on covenant breaches. So, for example, could the fund still pay out management fees or make investments or tax distributions? And the GP's ability to control the fund after a default. This is a typical structure chart for a simple subscription facility with a basic master feeder structure. The master fund would most typically be the borrower and would pledge to the lenders the capital commitments in the master fund, including the capital commitments that the master fund has from its feeders. The feeders, in turn, in order to get the capital commitments, in order to get credit for their capital commitments in the facility, the feeders would guarantee the fund's obligations and pledge the capital commitments of the investors in the feeders to the lender to secure the guarantee. So it's a pretty simple structure. It gets a little bit more complicated in a number of different ways. One example to show how these structures get a little bit more complicated, it's pretty typical in funds that we see for a master feeder structure to have one or more feeders where 25% or more of the investors are benefit plans, but the overall investor base is still below 25% ERISA. And the ERISA feeders hardwire to invest only in the master fund so that the master fund doesn't have to be managed as an ERISA fund. In that case, even though it's pretty transparent from the fund management perspective, there are implications for a subscription facility, and the lender in particular is not going to want to have a direct guarantee by the feeder funds because this could be seen as creating privity between the bank and a benefit plan vehicle. To avoid this, the feeders instead give their pledge in favor of the master fund to secure the feeder's own capital commitments to the master fund, and then the master fund on-pledges the benefits of those pledges to the lender in addition to its own capital commitments. So the security package there would be I give you a pledge of my capital commitments, the account that they get deposited into, et cetera, and also the benefit of the guarantee and pledges that I have from my feeder funds. Another possibility not on this chart is if the entire fund is over 25% ERISA. This doesn't prevent use of a subscription facility, but the lenders in that case would probably require an opinion of counsel that the fund is being run by a QPAM or as a VCOC to make sure that there are no ERISA issues. And with that, I think, Matt, I believe it's over to you.
Chris, thank you very much. I'm Matt Kerfoot, as Cindy mentioned before, and I'm going to carry on from the subline discussion, talk about NAV or NAV facilities. And I'm just looking around the room. I think this is maybe one of the most exciting topics we're going to be talking about. I don't know if there's agreement on that, but in the NAV facility space, there are sponsors who have done multi-billion-dollar syndicated deals, and then I have some sophisticated people say, well, what is a NAV facility? So there's quite a range of familiarity, of degrees of familiarity, and this is ABCs of fund finance. So we'll probably err on the side of the more basic, simplistic understanding of NAV facilities. So at the most fundamental level, NAV facility is basically a credit facility. It can be at the fund level, it can be at the SPV level, but it's secured by the net asset value, or secured by the limited partnership interests of a fund of funds or a secondaries fund, or the holdcos, a traditional private equity fund. And the NAV is obviously the net asset value of that portfolio. And I'll show you a structure chart in a moment or two. Another interesting thing about NAV facilities is that I think there are different views on what a NAV facility is, or even whether it's NAV facility or NAV facility. But I generally see two broad categories, and there can be some overlap, but I think of like diversified fund of funds or secondary funds, portfolio leverage. So I got a term sheet this morning from a bank. We're representing a client. The fund has a portfolio of private equity funds. The bank is going to lend at the fund level or an SPV level. We'll get into some of that detail. And the loan will be secured by that private equity portfolio. That is what I think of as sort of the broad, diversified portfolio financing. You also see this quite a bit with acquisition financing of portfolios, like the 30 to 40 LP secondaries portfolio financing that originally started in the financial crisis. And I'll talk a little bit more about that. Then the second category I would view as more targeted, off-the-run financings for a concentrated portfolio. So sometimes you'll see a sponsor with a fund, deep in the life cycle that's looking to spin out or roll over a couple of the portfolio companies. A bank will, again, lend to the fund or at an SPV level, and the security will just be those limited number of LP interests. The collateral, though, is basically LP interests or holdcos, but it's basically an equity pledge. And typically, but not always, you'll have the lender will have a security interest over the distributions and liquidation proceeds. So obviously, you have a security interest over the related deposit account. All right, next slide. So I had mentioned, I just want to take a quick look at a structure chart. Again, this is pretty basic. In this example, we have the fund and the lender. The fund is holding a portfolio of limited partnership interest. That's the term sheet that I got this morning, where the fund is pledging its interests in the portfolio of private equity funds. As I mentioned, you can also have a lender obtain a security interest over the holdcos that are holding the portfolio companies. In this chart, there's a reference to a pledge of a holdco equity or LP interest, particularly with pledges of private equity interest. As you know, there are restrictions on assignments, pledges, and transfers. And so you can get consents, obviously, get consents from the GP, which is becoming more and more common. But there are a number of other structures to address those pledge and transfer restrictions that if we have some time, we'll get into later in the presentation. Okay, so I just want to talk briefly about common uses for NAV facilities. I'm working with a bank that is showing a term sheet to a private equity sponsor, and they've actually have never done an NAV facility. We're putting it in place primarily to provide financing to the GP and other LPs against their interest in the fund. But at the same time, they said, well, maybe we can use this for some other purposes. And so I just want to go through what some of those other purposes may be. And again, I'm categorizing this by diversified NAV facilities and concentrated NAV facilities. So first, for the diversified NAV facilities, sometimes the fund will simply have a facility in place at the beginning of the fund, near the beginning of the life of the fund. Typically, we'll have a subline. It may have a hybrid for financing, the initial acquisition of limited partnership interests. But it may be a basic facility to provide an increase in the IRR. It might be as simple as that, or it might be a leveraged share class that investors may invest in, and the leverage is provided by a bank secured by the private equity interests. Another diversified NAV facility is basically an acquisition finance mechanism that I mentioned earlier. A credit line is put in place. It's secured by existing LP interest. It's used, or there are drawdowns on the facility to acquire additional LP interests. Another use of NAV facilities in this category is where the fund, the sponsor, as is often the case, may not be able to invest fully, depends on the LPA, but may not be able to invest fully in the portfolio, holds back, say, 20% of the portfolio. That's traditionally done for follow-on funding, for additional rounds of capitalization of portfolio companies. In this case, if the LPA allows it, the fund could actually invest fully and has a line to draw on rather than relying upon holdback. So for shifting down to the concentrated NAV facilities, sometimes the sponsor may have, say the sponsor has 20 companies in its portfolio. It may want to roll out, say it wants to continue managing two of those companies. The other LPs or certain LPs don't want to participate. The GP can roll out those investments into another fund. It often does that through the use of a credit line, again secured by the underlying holdco equity in this case. Below this, I mentioned strategic financing of certain portfolio companies. The key word here is certain. Again, I'll talk a little bit later about obtaining debt at the portfolio company level, but obviously it's somewhat easier to obtain financing on a broader portfolio of holdcos than it is on an individual company. So some sponsors will look to finance some part of those portfolio company balance sheets through one of these concentrated NAV facilities. And finally, leverage co-investments. And this actually could be a diversified NAV facility. Depends on what the co-investment looks like. We had done a facility originally a few months ago that we closed where there were about 5 or 6 leverage co-investments. I'll circle back to this in a bit, but sometimes with a single co-investment LP, obviously there could be some issues with a subline, right, with a single LP. But some of those issues go away when you have a more diversified portfolio of private equity collateral. Okay, I have to speed up here a little bit. Just very quickly, I always think, maybe it's just me, but I think that it's interesting how this market developed. It's really only been around for 10 years. During the financial crisis, there were a number of LPs. Obviously, everyone was searching for liquidity. Many LPs and hedge funds redeemed, even out of very well-performing funds, but obviously the LPs can't redeem from the private equity fund. So there were a number of accommodation trades by banks where they would accommodate a very important client, and they would basically provide liquidity to the LP to transfer the LP interest to another investor. It was kind of like trial by fire. Banks were comfortable with hedge funds financing because if there's a foreclosure, the bank can redeem from the funds. Private equity funds, obviously, it's very different method of foreclosure, and we didn't have the sort of robust secondaries marketplace that we had 10 years ago. But that's really how this business started, and a lot of the desks, if not most of the desks that provide the financing today, are still the old fund of funds financing desks that were the equity derivatives desk, and still, even today, for another client, we did an NAV facility, and we also did an equity swap on a fund. It's the same desk. All right. As I mentioned at the outset, this is really a focus on the ABCs of fund finance. So I'm just talking about the uses of these facilities, and then I'm going to, I have a number of, I think, pretty interesting slides in the back on how NAV is calculated and some of the legal issues that we deal with when we put these facilities in place. We'll have to talk about those another time. I just want to finish, now that I have basically a minute, I just want to finish on the current state of the market. We just talked about how this market developed, but the current state of the market is basically, it's transitioned from this crisis environment to a calmer, I think, more thoughtful business. As I mentioned, we have general diversified portfolio, IRR trades, secondaries, portfolio acquisitions, spin-outs, rollovers. Some of these deals are led by LPs that want to refinance their position, want to move their position. Some of these are led by GPs. Some of these deals, we're working on a transaction where it's a pretty well-known trade in the market, but there's a Japanese bank that has to move off its balance sheet 35 limited partnership interests. These are the types of transactions where the bank will come in and provide that acquisition finance. The last thing I did want to mention is just a little bit more detail on some of these other transactions. So I went too far. The SMA leverage transactions, we talked about the difficulty of getting a subline. That is alleviated in many cases by obtaining the perfected security interest over the portfolio. Another use of these facilities today is acceleration of cash flows from portfolio companies. Dividend recap, obviously, is the most common sort of plain vanilla example. There are many other uses of NAV facilities for acceleration of cash flows. Recapitalization of portfolio company leverage. I mentioned the difficulty that we've heard from sponsors in getting mezz-type debt, and that can be addressed in part through an NAV facility across a broader swath of funds. And finally, what we're seeing, I guess more recently, I think there's been some take-up, is a GP really looking to continue its fund. Say it's reached the 10-year cycle. It actually wants to continue that fund. The LPA doesn't allow for it. The GP is leading the creation, frankly, of a continuation fund. That is a fund that's going to continue on with the management of certain select portfolio companies. And the bank will facilitate the transfer and acquisition of those facilities, of those portfolio companies. All right, there's much more to say here. I think I've run out of time, though, and I have to transition to my friend and colleague, Jay Alekhandri. Jay, do you want to move ahead?
Yeah.
Okay.
Well, thanks, Matt. I got to tell you, it's really great to see all the different types of products that are available to managers. And I think this webinar only scratches the surface of the various types of financings that are available. And particularly for large asset managers, it really presents an opportunity to discuss, to diversify their various sources of liabilities. So the next facility we're going to discuss is the asset-based facility directly at the fund level. And in my mind, if a manager could only have one financing, the ABL facility at the fund level is one of the most attractive and one of the best for liquidity management. And I think that the focus in the next 9.5 minutes is really going to be on the flexibility of these types of facilities. So as a general matter, these facilities are often structured as a revolver with a borrowing base consisting of qualified investments, which will either be loans or equity. The facilities can also take the form of a term loan, and they can also oftentimes provide capacity to borrow in foreign currencies, which of course then could be used to lend to foreign underlying borrowers. In addition, these facilities often provide LC capacity, which can also then be used for LC capacity for underlying investments. As funds grow, these facilities provide flexibility for the manager to use an accordion feature so to get the facilities bigger. And they're unlike other facilities that my good friend and colleague that's going to talk about in a little bit, Cindy, there's no minimum utilization on these facilities. So we've also seen these type of facilities structured in a manner where they're umbrella facilities, so they cover multiple related funds. So what does the borrowing base look like in an asset-based facility at the fund level? So unlike other financings, you'll see a lot of different assets in there. You'll see debt, you'll see first lien, of course, but you'll also see second lien. You'll see first out, last out. You'll see high yield. You'll see mezz loans. You'll see dips. And you'll also see certain qualified equity investments. For larger managers, you may actually also see baskets for non-performing assets. So after all, even if a borrower is in default, the loan isn't worth nothing, right? There's some value there. So keeping with our flexibility theme here, again, I want to keep picking on you, Cindy. Unlike what my friend Cindy, the type of financing my friend Cindy is going to talk about next, when in these type of financings, there's no approval rights when a asset manager makes an investment and wants to put an asset in a borrowing base. So, as long as an asset meets the specified criteria, it gets credit in the borrowing base. That gives a manager, absolute certainty. They know on day one what they're getting. They know they don't have the risk of the lender waking up tomorrow, changing its mind, or there's a turn in the cycle, and not being able to get leverage on their investments. Things like advance rates, eligibility criteria, and concentration limits. Obviously, we could spend an hour talking about that, and they will, of course, vary depending on the size of the manager, their track record, the asset mix. But as a general matter, advance rates for quoted senior loans under these type of facilities, we've seen them be as high as actually 85%. And generally speaking, the difference in the range of rates in the same exact asset for quoted versus unquoted assets is anywhere between 5 and 10%. So as I noted, as you'd expect, you'd see concentration limits in the borrowing base. So there's generally a minimum number of senior assets that the lenders want to see. There will be a minimum number of unaffiliated issuers that are part of the portfolio. There will also be industry concentrations, as well as a maximum, generally speaking, there'll be a maximum basket on what the riskier assets look like. So you won't have a borrowing base that just consists of mezz loans or equity. We also are seeing in deals now adjustments in the concentration limits. So as the asset coverage ratio gets lower, the more senior assets the lenders are going to expect to see, and vice versa is true as the asset coverage ratio is higher. So eligibility requirements in the borrowing base will generally exclude, as you would imagine, certain types of investments. So you won't get credit, for example, for the equity of a subsidiary of the fund. You won't get credit for the equity of a joint venture, right? You won't get credit for structured finance obligations. Loans to borrowers in certain countries, of course, won't be included. Loans to borrowers that are highly levered, or loans to borrowers that don't hit a minimum EBITDA target, or loans with maturity dates greater than a number of years, also will generally be excluded. So one of the biggest advantages, again, is the flexibility for the manager to be able to operate the business of the fund. And that will come in multiple areas, including the ability for the manager to make distributions out of the fund. So as a general matter, even in an event of default scenario, 100% of net investment income or the amount of taxes that are owed can be distributed out. There are other distributions that are allowed too, subject to other requirements, like not just no event of default, pro forma compliance with financial covenants, or a borrowing-based cushion to allow for redemptions and other types of distributions. There's also, in allowing the manager to operate the business, really no limitations on investments that the fund can make, as long as a general matter, it complies with law and the fund's investment policies. That doesn't mean that an asset will get put in the borrowing base, but it does give the manager the ability to say, hey, even if I'm not going to get leverage on this, I can still, make this investment if I think it's a good investment. These facilities also take a look at the whole picture, right? And what they do is they allow debt at not just at the fund level, but they also take into account the SPV financings that Cindy's going to talk about in a little bit. It takes into account the ability of a fund to have an SBIC underneath it. Obviously, there's going to be restrictions on the ability to get assets down at that level, generally speaking. But again, like I just said, there's also allows debt at the fund level. So you generally will see uncapped, unsecured debt and secured debt as long as both are outside the preference period. And, the intercreditor terms, generally speaking, for secured debt will be picked up in the guarantee and security agreement. But these facilities oftentimes allow other types of debt, whether including derivatives. These facilities also allow, keeping with the flexibility theme, the ability to use cash and loan proceeds to do all the things we just talked about, right? There's no waterfalls, there's no sweeps, there's no lock boxes that govern how cash is used and provide restrictions on the ability to do distributions or make investments. So some of the other advantages include the fact that in these type of facilities, there's generally no or small prepayment penalties. There's no make-call premiums or no calls. And the facilities really generally only require prepayments. One, if there's a borrowing-based deficiency. And in that case, generally, to avoid fire sales of assets, many facilities allow the borrowers to come up with plans to show lenders how they'll cure a borrowing-based deficiency instead of having to make payments immediately. And after the revolving period, which is generally 3 to 4 years, the loans go into what we call a term out period, which will then require mandatory prepayments, which will either be a straight line amortization monthly over the term out period, or with the proceeds from certain events like asset sales, returns on investments, equity raises, and debt raises. These facilities often do have financial covenants. Sometimes they include all the ones that are listed on the next slide, but in most cases, you will see the minimum asset coverage ratio and the net worth test, and you will not see everything that is here. And last but not least, real quickly, the biggest complaint that folks have about these type of facilities is how valuations work. And it really depends on the fund's valuation policies as to whether or not this is an issue. But in 30 seconds, the way they generally work is you have to do internal valuations once a week, external valuations for quoted assets once a week, and where the rubber hits the road is how unquoted assets are treated. And unquoted assets have to be valued generally quarterly. And then there's a little push and pull on what portion of the unquoted assets have to be valued quarterly. Generally, the borrower will retain a third-party appraiser to value a certain percentage of the assets, with, of course, exceptions for sometimes for small assets. And then the lenders have a right to retain a third-party appraiser to value another portion of the assets, which is often a capped percentage. Since I went over here a little bit, why don't I unsmoothly pass the baton to you, Cindy?
Thank you, Jay. I appreciate it. And now on to loans to SPVs, asset-based loan facilities, which really are financings just of the portfolio of assets. They are not financings of the overall business of the fund like the ones Jay was describing. Many loan originators, loan funds, and BDCs use these types of financings for long-term leverage of their own portfolios, and CLOs use them to ramp their portfolios during the warehouse period. The reason people use these is typically a sponsor can obtain a higher advance rate and a lower margin than on many of the fund ABL facilities that Jay was talking about. There are no financial covenants. Recourse is only to the assets that constitute the collateral owned by the bankruptcy remote SPV. Lenders credit underwrite the loans that are permitted to be owned by the SPV. As Jay mentioned, some of these facilities are approval-based. In other words, the admin agent on behalf of the lenders has to review and approve each loan before it can be included in the borrowing base. Even in those circumstances, what typically happens is the lead lender has done really good due diligence and underwriting of the process that's used to originate and service the loans. And there gets to be an understanding between the lender and the sponsor of the borrower as to the types of assets that are going to go in the deal. And we've found with clients that use these that they actually work quite smoothly. Some facilities include a mark-to-market feature where the borrowing base is mark-to-market on an ongoing basis. This works with facilities that are collateralized by broadly syndicated loans where there are market prices on pricing services for the loans. It is not something that is necessarily used in all BSL facilities, and it is typically not used in middle market facilities which have illiquid loans that are less apt to be on a pricing service. All of these types of facilities include eligibility criteria for what loans are eligible to go into the facility. They include concentration limitations similar to the ones that Jay mentioned, tied to obligor, industry, type of loan, credit estimates on the portfolio, and other types of limitations. If the facility is being used to warehouse a CLO, typically the eligibility criteria and concentration limitations are tied to the portfolio that you need to get to in order to do a CLO execution. All these facilities also include a mechanism to revalue loans for borrowing-based purposes if a loan deteriorates in credit quality. So there's either a mark-to-market, or if you've got a loan that is more illiquid, the admin agent revalues the loan upon the certain events happening that indicate there's been credit impairment. And the borrower typically has a right to contest the valuation of the admin agent by obtaining an independent third-party valuation, although this issue is always negotiated as part of the facility negotiation. Defaulted loans are carried at zero. The borrowing base also haircuts similar to the borrowing bases Jay was talking about for loans purchased at a discount, excess concentrations, and certain other reasons. Borrowing base deficiencies have to be cured quickly, although lenders typically agree to an extension period for the cure to permit a parent fund to call capital to cure the deficiency, assuming there is unfunded capital available to be called. So those equity cure periods are quite customary because the lenders would prefer to have a performing loan than a loan in default. The advance rates vary by type of loan. First lien senior secured loans get the highest advance rates. Second lien and first lien last out loans get the lowest advance rates. The advance rates can vary somewhat considerably among these asset classes depending on the lender and on the borrower and sponsor and how long the sponsor's been in the industry, for example. There's no advance for anything other than eligible loans. And a minimum amount of equity in the form of loans contributed by the sponsor is required to be in the SPV before the first advance is made. Payments and proceeds from the underlying loans flow into an account that's controlled by the admin agent and can only be paid out in accordance with a waterfall. Cash that goes to the equity comes out last under the waterfall, and if there's an interest coverage test or an over-collateralization test that is not satisfied on a payment date, then that cash gets redirected and used to acquire more assets or pay down the facility until the test is met. The borrower is a bankruptcy remote special purpose vehicle. It can only do exactly what it's permitted to do. I mean, this is basically a structured financing. And it has separateness covenants, and it may not itself be a taxpayer. It has to be a disregarded entity or a partnership for tax purposes because the lenders don't want any tax leakage from the cash flow that they're relying on to pay off the loan. This type of facility, the terms of this type of facility vary depending on the purpose of the facility. If it's a CLO warehouse, the expectation is that a CLO will result once sufficient assets have been originated or acquired. There's an engagement letter with the CLO placement agent that the sponsor enters into, and typically an affiliate bank of the CLO placement agent provides the warehouse financing. There's always some type of set-off between the upfront fee that might be charged by the bank for its lending facility and the placement agent fee. Mechanics differ for different placement agents, but there definitely is a set-off in those fees. Usually there's a step up in the margin to incentivize CLO execution at the end of the period that it's expected to be needed for the ramp. There may be no unused fee for the facility because the facility is expected to be short-term. And there may be no make-whole unless the CLO fails to occur. If the CLO fails to occur and the placement agent hasn't gotten a fee and the bank didn't get an upfront fee, for sure there is going to be a make-whole to compensate the bank for its lending. These facilities are typically short-term, 6 to 18 months. We've certainly seen some that are even shorter than that. And the facility can morph into a longer-term warehouse if the CLO doesn't occur within the expected time frame. If the CLO can't get off because of arbitrage in the market, it's quite customary to see these facilities extended, and there may be a fee that's paid in connection with the extension, but they do get extended pretty regularly. The other type of facility is basically portfolio financing. And this type of facility is a longer-term warehouse. It has a 2 to 4 year reinvestment period and an additional 1 to 3 years to amortize the debt at the end of the reinvestment period. There may be a step up in the margin if the facility isn't used to the extent that it's expected to be used. These are usually revolving facilities during the revolving period. There's a make-whole if it's terminated before whatever non-call gets negotiated into the deal. There's an upfront fee payable to the bank, which gets repeated if the facility gets upsized. If this is a facility that's got a 364-day period to it and rolls because the bank prefers that for capital purposes, there's typically a fee that gets paid each time it rolls. These types of facilities can be managed to either structuring that's built into the deal or to a matrix, which allows flexibility in how you're going to run the portfolio. There are various collateral quality tests in these facilities, which, if they're not met, must be maintained and improved if you want to buy a new asset. And if you are financing revolvers or delayed draw term loans, dry powder has to be maintained under the facility commitment so that you have enough cash to fund the unfunded liabilities, or cash reserves have to be maintained. And with that, I am going to turn it over to Ian.
Thank you, Cindy. So before I start, one point to address, we've seen some questions coming in regarding the slides and whether they'll be available for download or review. Just to confirm that the slides will be posted to the website after the conclusion of the presentation. Shifting gears now. So as Cindy was talking about SPV level finance, we're now moving back up the capital structure to fund level finance, in particular financing through debt securities versus the type of facilities that Cindy J. and others were speaking about. Speaking about baby bonds, what is a baby bond? It's a senior unsecured note issued by a registered fund, and that's important. We're talking about funds such as business development companies that are registered and reporting with the SEC on a quarterly basis. They're sold in a registered underwritten offering, requiring an effective Form N-2 registration statement with extensive disclosure about the company and a prospective supplement that's going to be filed with the SEC. What's special about them? How are these different than other corporate institutional debt issuances that you see in every industry? They have small minimum denominations. So while a typical conventional or institutional corporate bond is going to have a $1,000 plus par value and typically is going to trade in large amounts, a baby bond is issued with a $25, for instance, face amount, and can be sold and bought in those small increments. They're listed on a national securities exchange, typically the NYSE. You can buy them using a ticker symbol on the NYSE the way you would buy equity securities. Often, as I mentioned, but not exclusively, issued by BDCs. What are the key terms? As I mentioned, they're senior unsecured notes, so they rank pari passu with other unsecured and unsubordinated debt of the fund, so they're effectively subordinated to any secured debt at that parent level. They're also going to be structurally subordinated to indebtedness and other liabilities of the subsidiaries. What are the economics and who's buying these and why? They're going to have a fixed interest rate with a relatively long maturity. So we're not talking about a year or two like some of these other facilities. These debt securities are going to be out for 5, 7, 15, in some cases 30 plus years from issuance. The economics, typically interest rates in the BDC space that are typically lower than the equity dividend yield. So while in today's environment you might see dividend yields 9% and higher, debt issuances through the baby bond market are going to be more in the 5 to 7% range, depending, of course, on the issuer and the specific terms of an issuance. Interest is paid quarterly. That's another distinction from a typical corporate bond, which would have semi-annual interest. So why structure these bonds in this way? Generally speaking, this is an alternative for an investor who may want exposure to the BDC space, regular income through the coupon, but a willingness to accept a lower rate of return, a lower coupon, because you're senior in the capital structure to the equity. From the issuing fund's perspective, optional redemption is typical in these instruments. They're typically callable at par prior to the maturity date. So these are not instruments that are going to lock you in. If you put out a 15-year bond, you're not going to have to pay a make-whole if you want to refinance that instrument after 7, 8, 9, 10 years. The extent of a no-call period is subject to negotiation. Typically, if you're issuing a 7-year note, maybe no-call 3 years, a 15-year note, maybe no-call 5 years. That optional redemption facilitates opportunistic refinancing if there's a lower interest rate environment or there are other more attractive means of financing. As far as restrictions on operations, very few, limited covenants. There are, of course, statutory leverage restrictions under the recent SBCAA. Those have been loosened somewhat, but they still would cap leverage at the fund level. So who's buying these and what are they designed for? It's a way for the fund to tap potential retail investor capital. They trade on the NYSE or other exchanges. They're in small denominations. The idea here is you can raise capital from relatively small investors with a security that's more liquid, more easily bought and sold than a typical institutional bond. Shifting gears to another parent-level instrument, another type of debt security, this one geared towards a very different market and serving a different purpose. I'll talk a little bit about convertible notes. So what are we referring to? It's a debt instrument with a fixed interest and maturity, but also providing the potential to convert into equity, essentially a hybrid that can provide current yield along with downside protection with the upside of an equity instrument. Typically, you're going to be issuing these at a lower coupon, lower interest rates than other senior unsecured bonds, such as baby bonds or conventional institutional bonds. Similar to baby bonds, they'd rank pari passu with your other unsecured and unsubordinated debt. They may, of course, be issued in a registered underwritten offering, although more often than not, they're issued under a Rule 144A private placement, and I'll talk a little bit about what that means. Rule 144A is not limited to convertible notes, of course. You can issue straight institutional bonds under Rule 144A, but essentially we're talking about an unregistered offering, does not require a prospectus being filed with the SEC, limited to qualified institutional buyers, essentially structured like an underwritten offering, where you have initial purchasers that are analogous to underwriters in a registered deal, acquiring the notes in a private placement, turning around and reselling under 144A to QIBs. These securities are restricted securities and can be sold and bought by and among QIBs, but not outside of the qualified institutional buyer universe. Who are the buyers? Who are these QIBs? Generally institutions that own or invest at least $100 million of unaffiliated securities. So these are the most sophisticated investors, typically. Must be an institution, no individuals without regard to the sophistication or wealth of that individual. Issues unique to convertible notes in a 144A offering, they cannot be fungible with illicit security. So to the extent you're putting out a convertible note that is convertible into equity that's listed on the NYSE, for instance, you need to have at least a 10% above market conversion price to meet that non-fungibility rule. What else is attractive from the issuer perspective? While institutional bonds, typical corporate bonds that are issued in a 144A offering are often paired with registration rights requiring the filing of a registration statement to do a registered exchange offer within a year of issuance, convertible notes issued in a 144A offering typically are not subject to registration rights. They could be, but typically are not. Instead, the issuer will typically agree to take steps to allow holders to sell under Rule 144 and remove restrictive legends from the notes after a one-year holding period. As far as disclosure requirements, from the fund's point of view, you'll have an offering memorandum that typically tracks the level of disclosure that would be included in a prospectus, although it's not a statutory prospectus filed with the SEC. What are the key terms people negotiate? Anti-dilution protection. The initial conversion rate into equity is going to be subject to adjustment for things like dividends above negotiated levels. Sometimes there'll be conversion conditions when you can convert. Covenants are typically limited. They'll typically be fundamental change, repurchase offers, and a make-whole fundamental change adjustment to the extent that there's a sale of the company providing additional return to the holders. Convertible note holders want call protection, so unlike a baby bond, which is typically freely callable after a short period of time, these holders will have some protection. And then there's a question of whether it's settled in cash, shares, or often a mixture. One last instrument that's worth discussing briefly, private placement notes. Here it's another debt security that's going to be issued directly by the parent fund In contrast to the 144A offering we just talked about, or the registered baby bond offering, these are direct sales from the fund to the investor. No underwriter or initial purchaser in the middle. In these sales, you're going to have no filings with the SEC. It's what we'd call a Section 482 exempt offering. And what's interesting about these is that the note is directly sold to an institution, typically insurance companies, often life insurance companies, who are buying to hold. These are not going to be actively traded. There's no indenture. There's no indenture trustee. The agreement is directly with the note purchaser. That provides flexibility in disclosure for the issuer. The issuer has no requirement to provide specific information, although typically you're going to have a private placement memorandum or other disclosure package providing significant information to the investors. What are the key terms? Unlike the convertible notes or the baby bonds we just talked about, there will be some more fulsome covenants in these private placement notes. Negotiated points will often include prepayment, whether they're change of control repurchase offers, make-wholes, or in some cases negotiated prepayment premium amounts that are something less than a make-whole, the provision of information, affirmative covenants typically limited to things like compliance with law. You will see some negative covenants around things like affiliate transactions, liens, restricted payments. Financial covenants are typically specifically negotiated. And another interesting point is you'll typically have a ratings condition. The insurance company market are going to require a rating. That'll be negotiated whether there's a condition to close and also a maintenance of rating condition. So we've come to the end of the time allotted. I will turn it briefly back over to Cindy.
Well, thank you, Chris, Matt, Jay, and Ian, and everyone who has participated in this webinar. We have received a number of questions that we will respond to by email after the webinar, and yes, this will be posted on the Dechert website. So once again, thank you very much. See you later.